How is the Ukraine crisis affecting financial markets? The hardship and disaster brought on by the Ukraine crisis, slower development, and higher prices will have an impact on the whole world economy. There are three basic routes via which impacts will move. One is that increased inflation due to increasing pricing for necessities like food and electricity will reduce the purchasing power of earnings and reduce demand. Two, a historic increase in refugee movements will put a strain on nearby economies, which will have to deal with interrupted supply chains, payments, and commerce. Third, lower asset values will result from investment market uncertainty and lowered company confidence, worsening financial conditions and perhaps causing capital outflows from developing countries. The biggest suppliers of consumables, Russia and Ukraine, have seen their prices surge due to interruptions, particularly for oil and natural gas. Food prices have increased, with wheat prices reaching a record, with Ukraine and Russia accounting for 30% of world exports. Energy and consumables. The largest producers and exporters of several food goods worldwide are Russia and Ukraine. These are the leading two producers of sunflower oil, with a combined 60% of global production, according to S&P Global Platts. Furthermore, these nations export 28.9% of the world's wheat, according to J.P. Morgan. The supply networks in both nations have been hampered by the conflict between Russia and Ukraine. Sanctions have limited Russian exports, and the conflict in Ukraine has shut down its ports. The price of wheat on the Chicago Futures Exchange has already increased due to the dispute to 14-year highs. Russian oil and natural gas are used to fuel companies, heat houses, and fill gas tanks in many European nations. The instability of Russia's power generation poses a risk to the global economy, which will cause the Russia-Ukraine issue to delay global growth and increase inflation. A consistent cycle of monetary and fiscal policy tightening is still predicted by J.P. Morgan's research because of strong demand and fast constricting supply, which contribute to ongoing inflationary pressures. Over 10% of the world's oil and natural gas output comes from Russia. Although risks are still biased to the extreme, the financial baseline expectation is that until July or August, the price of crude oil will be revolving around $100 per barrel, and that the price of European natural gas will stay around 110 euros per megawatt hour. Russian crude oil shipments to Europe and the US might drop by as much as 4.5 million barrels per day if energy supplies are further restricted. As per financial estimations by the World Bank and IMF spanning a wide range of 1 to 3 in projections, it is difficult to determine the exact degree of the fall in Russian oil exports. The US and Europe receive 4.3 million barrels of Russian exports. Under the worst situation of a comprehensive prohibition, it would reduce global GDP by 3% annually and increase the global consumer price index by 4% annually, assuming the drag completely disappeared in the first half of 2022. Consumer Price Index. According to J.P. Morgan's International Finance Team's system of equations, the impact on global economic growth would be 1.6%, assuming this stays only a negative supply shock and if the price of oil hits $150. The battle has accelerated global inflation in recent days, driving up the cost of essentials like oil and natural gas. The current supply chain problems brought on by COVID-19 have been made worse by the potential destruction of some transportation infrastructure, notable ports in Ukraine, and financial restrictions on Russian exports. Sea freight routes via the Black Sea will remain constrained for an unknown amount of time due to Turkey's decision to restrict transit through the Bosphorus and Ukraine's decision to halt merchant traffic. This will have an immediate impact on grain exports passing via ports in Russia, Ukraine, and potentially Romania and Bulgaria. It is difficult to forecast how the situation and markets will develop, but it appears that we are headed for a time of high energy prices caused by conflict and coupled with tight market fundamentals. Consumers pay high rates at the gas pump, on their gas, heating, and electricity bills. High energy costs also raise the cost of almost all products and services, which feeds predictions of inflation. As we saw in Afghanistan, Iraq, and Iran, when the United States attacked or imposed sanctions, the whole region became unstable. Some governments might enact policies to protect consumers from this rise. There is room for government intervention because taxes on diesel and gasoline often account for more than half of what customers pay at the pump. However, customers will be required to cover all of this expense. Unfortunately, it appears that we will have pricey energy for a while. A quick reminder, if you've enjoyed the video so far, consider subscribing, as we frequently upload such informative and educational videos. Let's continue. Sanctions and after effects. The effective functioning of Russia's financial sector has been the focus of the U.S. Department of the Treasury's sanctions against many financial institutions, notably Sberbank, VTB Bank, and its affiliates. The second largest bank in Russia, VTB Bank, along with 3 other financial institutions, are subject to sanctions that forbid American citizens from doing business with them and freeze any of their assets that have any connection to the U.S. financial system, as well as the assets of any entity owned at least 50% by the sanctioned institutions. The biggest bank in Russia, Sberbank, was targeted by the sanctions, which made it impossible for it to deal in dollars. The United States is also taking steps to block the Russian central bank from using its foreign reserves and to freeze any money transfers. The United Kingdom has placed harsh sanctions on Russia, directly attacking the banking system of Russia, the Russian country's wealth fund, Russian banks, the Russian state, members of Putin's inner circle, and the cash-rich Russians who are living their luxurious lives in London. According to the UK government's 10-point sanctions plan, big Russian banks will have their assets frozen, and major Russian businesses will not be allowed to raise money in the UK. This policy includes Russia's second-largest bank, VTB. This includes bans on the export of technical equipment, steps to prevent Russian enterprises from issuing transferable securities and money market instruments in the UK, and authority to bar certain institutions from obtaining pound sterling and processing transactions through the UK. In addition, the UK will restrict dual export permits to Russia, forbid the transport of some high-tech goods, and ban Aeroflot, the national airline of that nation, from entering the nation. Russia is mulling a ban on foreign planes accessing its airspace in response to these measures. According to the most recent data, Europe and the United States have chosen to exclude several Russian financial firms from using the interbank system. The economy, international trade, and different financial operations in Russia would all suffer significantly as a result of the SWIFT restrictions. Sanctions against the $600 billion in foreign reserves held by the Russian central bank are also being threatened by the US and Europe. Regardless of whether it prevails in the battle or not, Russia will pay a steep price for its isolation from the global financial markets as a result of the expulsion of the majority of its banks from the banking network. Global markets. Since the EU is not directly involved in the conflict, its direct losses are minimal. However, the geopolitical effects of the conflict that is geographically close to the region would cause the financial markets in Europe to be unstable, which will not only affect the European financial markets, but also cause the euro to lose value. The sanctions on Russia will also hurt Europe, which has deep economic links to Russia. Russian corporate and financial debt is a significant source of exposure for European banks, and any increase in risk might cause the global financial system to become unstable. The U.S. has very little to lose from the crucial geopolitical battles, and it is unquestionably advantageous for the more stable U.S. capital markets that a large portion of the cash removed from Europe is anticipated to flow back to the U.S. The United States' level of inflation will also continue to climb as energy costs continue to rise, creating long-term concerns for the country's financial industry. As a result, the Federal Reserve will have a harder time implementing its monetary policy, and the likelihood of the Fed making bad decisions in the future will only grow. This will make the U.S. capital market unstable. Regarding the effect on China, financial experts have pointed out that the USD/RMB exchange rate has increased once again. On February 26, the USD/RMB exchange rate fluctuated around the 6.30 level both onshore and offshore. Later on, the data revealed the RMB's association with global market volatility had fallen to a 3-year low, highlighting the currency's capacity as a haven. In reality, this indicates that foreign money is looking for new safe havens, increasing the amount of foreign capital entering China's domestic capital market and helping China's financial system to profit from the crisis. However, in the face of escalating geopolitical rivalry and war, China's capacity to preserve the stability of its surroundings continues to be a crucial factor for global capital flows. However, the conflict between Russia and Ukraine will affect the cost of food, commodities, and energy products like oil and natural gas. The recession in Russia will be made worse by the economic and financial sanctions imposed by the United States and Europe. Russia may still use its oil resources for geopolitical purposes, though. According to reports, Russia has significantly increased natural gas prices. The cost of natural gas has increased 41% across Europe. Furthermore, almost 35% of the palladium utilized in the U.S. semiconductor sector came from imports from Russia. The American chip deficit will worsen after Russia stops providing palladium to the country. Neon, another element utilized in the U.S. semiconductor industry, was also imported to a 90% degree from Ukraine during the same period. The battle may cause neon prices to spike, which might have some effect on the U.S. semiconductor market. Some market organizations have predicted that crude oil prices may surpass the $140 threshold once more, which would be advantageous for Russia, a significant energy exporter, and would offset the losses brought on by growing financial settlement costs. Undoubtedly, changes in the supply and demand in sectors like energy and consumables will increase rising inflation on a worldwide scale. Financial markets have always been one of the most globalized domains, and if a global conflict develops, this shift will have long-term repercussions for the growth of global financial capital markets. Europe and the United States, which have financial benefits, have placed financial sanctions on Russia, exposing the global financial industry to geopolitical risk and raising financial transaction fees and hazards. These policy and market developments resulting from the Russia-Ukraine war will raise global capital's risk. Did you enjoy the video? Please hit the subscribe button, like, share, and comment.